$74 billion. That's not a typo. That's how much wealth vanished overnight when one accountant discovered a lie so massive it destroyed America's seventh largest company and sent shockwaves through Wall Street. You need to hear this story because the exact same tactics are being used right now by companies you probably invest in. I'm going to reveal exactly how Enron fooled the smartest people in finance for over a decade. And by the end of this video, you'll understand why your retirement account might be hiding the next Enron. But first, you need to know how an everyday accountant became the person who exposed the biggest corporate fraud in American history. Let me introduce you to Mike. He thought he understood how big corporations worked. Like millions of investors, he believed the numbers he saw. But Mike is about to discover what happens when those numbers are built on lies. Here's what everyone thought was happening. Enron was an innovative energy giant, transforming how America bought and sold electricity and natural gas. They were on every best companies to work for list. They were worth more than Coca-Cola. But the truth? It was all smoke and mirrors. And I'm going to prove it to you with internal documents, whistleblower testimonies, and accounting tricks that Wall Street banks helped hide. Quick legal note, this is educational content about documented history, not financial advice. Always do your own research and consult professionals. Let me show you exactly how this house of cards was built. This is exactly what was happening to millions of Americans in the late 1990s. Enron's stock price was skyrocketing while the company was secretly hemorrhaging money. Employees had their entire retirement savings in Enron stock. Pension funds across America invested billions. Why? Because every quarter, Enron reported massive profits. But those profits were fabricated through something called mark-to-market accounting. Here's how insane this was. Enron could predict future profits from a 20-year energy contract, claim those profits today, and book them as revenue immediately. Think about that. They were counting money they hadn't earned from contracts that might never make a profit, as if it was already in the bank. The numbers tell the story. In 1998, Enron reported $31 billion in revenue. By 2000, $100 billion. Their stock hit $90 per share. This made Enron more valuable than Pfizer, AT&T, and Boeing. But here's the part that makes it worse. Not a single major bank, ratings agency, or analyst questioned whether these numbers were real. Why? Because they were all making too much money to ask questions. Look at these numbers. In 1998, Enron reported $31 billion in revenue. By 2000, that number exploded to $100 billion. But their actual cash flow? Negative. They were burning through money faster than they could borrow it. Let's break down the mechanism behind this fraud. I've studied corporate accounting for 15 years. And what most people miss is that Enron didn't just break the rules. They rewrote them with help from their auditors. There are three critical components you need to understand. First, mark-to-market accounting. This allowed Enron to book future estimated profits as current revenue. Imagine you open a lemonade stand and immediately claim all the profit you think you'll make over the next 20 years. That's what they did. Second, special purpose entities, or SPEs. These were off-balance sheet partnerships where Enron hid billions in debt. It's like having a secret credit card your spouse doesn't know about, except with billions of dollars. And third, the enablers. Arthur Andersen, one of the world's biggest accounting firms, signed off on everything. Investment banks like Merrill Lynch and Citigroup helped create these schemes. They all profited from the lie. Each of these components played a critical role in building a $74 billion house of cards. Let me show you how this actually worked in practice. Now, here's the loophole that Enron executives exploited. In 1992, Enron received permission from the SEC to use mark-to-market accounting for its trading business. This was meant for short-term commodities contracts, but Enron expanded it to everything. They'd sign a contract to build a power plant in India, estimate profits for the next 20 years, and book all that money immediately as revenue. Imagine you're a real estate developer. You break ground on an apartment building that won't be finished for 3 years. Under normal accounting, you can't claim profit until you actually sell or rent those apartments. But with Enron's method, you could predict how much rent you think you'll collect for the next 30 years and claim all that profit the day you start construction. Insane, right? That's essentially what was happening here. The legal framework allowed this because the contracts were technically tradable assets. The company could claim they had market value even though there was no real market for them. According to SEC filings, this resulted in Enron reporting profits while their bank accounts showed cash flowing out. And the average investor? They had no idea this was even possible. Why didn't anyone talk about this? Because everyone was getting rich. Executives had stock options worth hundreds of millions. Banks earned massive fees. Auditors billed millions per year. The system was designed to reward silence, not truth. Every single day, 20,000 Enron employees went to work believing their retirement was secure. Pension fund managers across America believed rating agencies that gave Enron AAA credit ratings. The system was designed for executives and banks to profit, not for everyday investors to succeed. And the person who would expose it all? She wasn't a government regulator. She wasn't a journalist. She was an accountant who just wanted to understand the numbers. Now, here's where it gets even more disturbing. The person who discovered this fraud worked inside Enron. She tried to warn people for months. What she uncovered about the company's partnerships with executives will shock you. The evidence is undeniable, and it's about to show you why you should never blindly trust any company's financial statements. Let me walk you through the evidence. According to Sharon Watkins' now famous memo to CEO Ken Lay in August 2001, Enron was about to implode in a wave of accounting scandals. The documents show that CFO Andrew Fastow created partnerships called LJM1 and LJM2, named after his wife and kids, by the way. These partnerships existed for one purpose: to hide Enron's losses. Here's the timeline. In 1997, Fastow creates the first special purpose entity. By 1999, he's running multiple partnerships while still serving as Enron's CFO. See the conflict? He's negotiating deals between Enron and entities he personally controls. By 2000, these partnerships hold over $1 billion in Enron debt and losses that don't appear on Enron's balance sheet. The connection? Fastow personally made $38 million from these partnerships. Meanwhile, Enron stock hit its peak of $90 per share. Employees were locked into holding their Enron stock in their retirement accounts while executives were cashing out. The numbers don't lie. In October 2000, Enron's stock was worth $90. By December 2001, 67 cents. That's a 99.3% loss. This isn't theory. This is documented fact. And here's what actually happened when one accountant decided to investigate those partnerships. But the most shocking part? This wasn't discovered by the SEC. It wasn't uncovered by journalists at first. It was one accountant, Sharon Watkins, who spent weeks trying to get someone to listen. What this means for your investments, your retirement, your financial future is something you need to understand right now, because the tactics Enron used, companies are still using variations of them today. Let me explain why this matters to you. Here's what this means for you specifically. Your retirement account, your pension, your investments, they're all vulnerable to the exact same schemes if you don't know what to look for. This affects you in 3 critical ways. First, the illusion of safety. Just because a company is big, prestigious, or highly rated doesn't mean it's financially sound. Enron was Fortune's most innovative company for 6 consecutive years. They fooled everyone. If your investments are concentrated in your employer's stock or in companies you haven't researched, you're exposed. Second, the complexity trap. Modern financial statements are intentionally complicated. Companies use special purpose vehicles, derivatives, and accounting techniques designed to obscure reality. If you can't understand a company's balance sheet, that's a red flag, not a reason to trust them. Third, the conflict of interest problem. The people who are supposed to protect you, auditors, analysts, ratings agencies, are paid by the companies they evaluate. Sound familiar? That's still how the system works today. If nothing changes, we're looking at more Enrons. We've already seen it with the 2008 financial crisis, the WeWork scandal, and several other corporate failures. That means your 401k, your pension fund, your life savings could be invested in companies using similar tactics right now. Think about your current situation. Are all your retirement funds in your employer's stock? Do you understand what's actually in your mutual funds? Have you checked if your investments are concentrated in just a few companies? These aren't coincidences if the answer is yes. They're direct results of a financial system that prioritizes short-term profits over transparency. This is the reality that 20,000 families faced. Lifetimes of savings, gone. Dreams of retirement, destroyed. But there's something you can do to protect yourself. The tools exist, the knowledge is available. You just need to know where to look and what questions to ask. Here's the good news. You're not powerless. There are 5 specific actions you can take starting today to protect yourself from the next Enron. Action number 1, diversify ruthlessly. Never have more than 10% of your retirement in any single company, including your employer. This protects you from total loss. If Enron employees had followed this rule, they would have saved 90% of their retirement funds. Action 2, read the footnotes. I know, boring, right? But that's where companies hide the truth. If you see terms like off-balance sheet obligations or related party transactions, investigate deeper or avoid that investment. Action 3, watch the insider selling. When executives are cashing out their stock while telling employees to hold, that's your warning signal. Public filings show this information. Use it. Action 4, verify with multiple sources. Don't rely solely on company reports or analyst ratings. Check cash flow statements, not just earnings. Real businesses generate cash, not just accounting profits. Action 5, trust your gut. If something feels too good to be true, it probably is. If you can't understand how a company makes money, don't invest in it. I'm not giving you financial advice. Always consult with licensed professionals for your specific situation. I'm showing you the red flags that informed investors watch for. These are the same warning signs that were visible with Enron before the collapse, for anyone paying attention. So now you know the truth about Enron's $74 billion lie, and more importantly, how one accountant's courage exposed it all. The question is, what are you going to do with this information? Are you going to check your portfolio concentration today, or wait until it's too late? I want to hear your experience in the comments below. Have you ever worked for a company that seemed too good to be true? Do you have all your retirement in your employer's stock? Let's discuss. Your story might help someone else avoid disaster. If you found this valuable and want more people to understand these financial warning signs, hit that like button and share this video. Someone you know might need this information. Subscribe if you want to stay ahead of financial scandals and learn how to protect your wealth. And if you want to understand how the 2008 financial crisis used similar tactics on an even bigger scale, I've got a video that reveals the banks that were too big to fail, but not too big to fraud. Check it out next. You'll be shocked by the parallels. Thanks for watching. Stay informed, stay protected, and never blindly trust the numbers.